stop what you're doing because this isn't a someday story. This is moving right now, Wednesday, January 28th, 2026. In the last 72 hours, one decision climbed to the top of the risk board, and almost nobody on TV is connecting it to metals. The White House is preparing to name the next Federal Reserve Chair. The market is already trading the name before it's even official. If you think this is just politics, you're going to miss the trade of the year, because a Fed chair signal can reprice the dollar overnight. Quick favor. Before we go deeper, hit like, subscribe, and turn on notifications. If this breaks while you're asleep, you'll want the update first. Now here's the hinge point. Jerome Powell's chair term ends May 15th, 2026. That's weeks away, not years away. And the moment a nominee is announced, they become a shadow chair. Markets start pricing their policy from day one. That means the real event isn't the swearing-in date. It's the announcement headline that hits your phone when you least expect it. In the betting markets and the rumor mill, a few names have been rotating fast. The loudest chatter has centered on former Fed Governor Kevin Warsh. Other candidates have been floated too, including economist Kevin Hassett and BlackRock's Rick Rieder. The list shifts, but the theme stays the same. The theme is simple. Whoever wins is expected to lean pro-growth. And pro-growth in an election cycle economy usually means easier money. Easier money has a fingerprint, lower real rates, and a softer dollar. And when the dollar softens, hard assets don't whisper, they move. That's why silver has been acting like it's allergic to calm. It doesn't drift higher, it lunges, pauses, and lunges again. On Tuesday, January 27th, silver traded around the $111 area per ounce in major benchmarks. That's not a small rally, that's a regime change. But the bigger story is what's happening off the screens. The physical market is starting to speak with a different voice. In parts of Asia, buyers have been paying far above Western paper benchmarks. When that gap widens, it's a stress test for the whole system. Because paper silver is a promise, not a bar. And when enough people demand the bar, promises get expensive. Think of it like concert tickets. The printed price is one number. The last available seat on the street is a different number. Now zoom out to the policy backdrop for 1 second. The U.S. is running heavy deficits, while interest costs keep climbing. That creates pressure for lower rates because high rates make the debt bill explode. This is the quiet math that sits behind every speech. So when traders see a Fed chair nominee who favors faster cuts, they don't wait politely. They front-run the policy path. And that front-running shows up first in currencies and metals. The dollar gets lighter and silver gets heavier in price terms. Here's the part most investors underestimate. Silver is not just a shiny thing. It's an industrial input that modern tech can't easily replace. Solar panels, electronics, medical equipment, high-end solder, defense systems. Silver is threaded through the supply chain. Demand isn't only emotional, and that matters because industrial buyers don't buy headlines. They buy inventory, and they buy it before the shortage hits. Now add the geopolitical layer that has been sneaking up on everyone. China tightened export licensing around key minerals, including silver. Beijing published a list of 44 companies allowed to export silver for 2026-2027. Fewer doors means higher bargaining power for whoever holds supply. When supply gets administratively constrained, price discovery gets messy. And messy price discovery is exactly how premiums are born. At the same time, exchanges have been battling wild volatility with rule changes. Margin requirements and trading controls are becoming routine headlines. That's not a conspiracy, it's risk management. But it also changes behavior because higher margins crush leverage and force liquidations, which creates those brutal drops that feel random on your chart. They aren't random, they're mechanical. And those mechanics are hitting the middle of the physical market, wholesalers and distributors. The people who normally smooth out supply are getting squeezed. Here's how. Many wholesalers hedge physical inventory by shorting futures. It reduces downside risk, but it can create a cash problem during a melt-up. When silver spikes, the short hedge bleeds and margin calls arrive daily. If the move is fast enough, operating cash gets consumed just to stay hedged. When operating cash gets consumed, the response is simple. No bids. If you can't finance inventory, you can't quote prices with confidence. That's why you're hearing stories of dealers being sold out or pausing quotes. In a fast market, nobody wants to promise what they can't deliver. And it's not only private dealers feeling it. Even official mints can struggle to price products cleanly when spot moves like a storm. Now, let's talk about the real fault line. Paper claims versus available metal. Futures, options, swaps, and ETFs can represent far more ounces than exist. In normal times, that's manageable because most contracts net out in cash. In stress times, more participants start wanting delivery-like certainty. When too many people want certainty at once, the system has to choose. It either reprices higher or it rations access through cash, settlement, and rules. And this is where the Fed chair story collides with the silver story. A dovish signal can pour fuel onto the demand side overnight. Because silver is priced in dollars, and dollars are priced in expectations. Change expectations, and the whole board resets. So the question isn't who will it be in some abstract way? The question is what that name tells markets about rate policy and credibility. And once credibility gets questioned, the move doesn't stay in bonds. It spreads into every hard asset that can't be printed. Block 2. Let's make this simple because the noise is designed to confuse. 3 forces are moving at the same time. Number 1, the shadow chair window from announcement day to May. Traders will position for the next chair's bias. That window can be more violent than the handoff itself. Number 2, the paper versus physical spread. When physical trades at a premium, it's the market charging for certainty. The wider the spread, the louder the stress signal. Number 3, liquidity and margin shocks. Margin hikes and forced selling can smash price in hours. Then scarcity pulls it back up because the metal still isn't there. Now picture those 3 forces colliding in 1 week. A headline Fed pick, a thin physical pipeline, and an exchange raising margins again. That's how you get a chart that looks impossible. Not because gravity stopped, but because liquidity vanished. And we've already seen the playbook this month. Explosive highs, sudden dumps, then sharp rebounds as buyers step back in. Some days it feels like the market is being yanked. Often it's just positioning, hedging, and forced risk reduction. Here's what matters. Volatility does not equal the end of the story. Volatility is what happens when 2 prices are fighting for dominance. On one side is the benchmark paper price. On the other side is the price paid by whoever must have real metal. When those prices diverge, confidence becomes the real commodity. And confidence is exactly what central banks are supposed to protect. That's why the Fed chair question is not a sideshow. It's a confidence variable with a microphone. If markets sense political pressure on policy, they price a risk premium into the currency. A weaker currency lifts hard assets by math. Also watch the bond market for tells. When long yields rise while growth headlines look fine, it's often a credibility tax. Now, about those dealer headlines, sold out doesn't always mean zero metal on earth. It can mean nobody wants to quote a moving target. Dealers survive on spreads, not heroics. If wholesalers go quiet, retail shelves go empty fast. And if you're wondering why more supply doesn't magically appear, remember mining is slow. A new mine takes years, not weekends. Recycling helps, but recycling also depends on price stability. In a whipsaw market, sellers freeze too. Meanwhile, industrial buyers can't pause the future. If they need silver for production, they will pay up to avoid downtime. That tug of war is why silver is different from a meme asset. It has a real economy anchor attached to it. Now, let's talk about what break could look like without the doom drama. There are a few paths, and each has different winners. Path 1 is convergence. Paper reprices higher until the spread shrinks. That's the cleanest outcome, and it hurts shorts the most. Path 2 is a 2-tier market. Paper remains a reference, while physical trades in private channels at a persistent premium. Path 3 is a settlement scramble. Exchanges protect stability by changing rules, and some participants learn the hard way what they owned. None of those paths require a movie-style collapse. They only require sustained imbalance, and we already have imbalance signals. So, what should you actually do with this information? Start with clarity, not adrenaline. First, separate exposure from ownership. A ticker can track price, but it can't guarantee access during stress. Second, respect position sizing. If a 10% intraday swing would wreck your sleep, your sizing is too big. Third, don't confuse paper dip with physical discount. Premiums can rise even when screens show red. Fourth, keep an eye on the calendar. A Fed nomination headline and a major margin change can hit the same week. Fifth, track the spread, not just the spot. The premium is often the earliest warning light. And if you're building a thesis, build it on multiple signals. Watch inventories, exchange rule changes, and physical availability together. One more twist people miss. Narrative cycles matter. When the mainstream celebrates stocks, it often ignores stress building elsewhere. That's why metal surprises feel sudden. They weren't sudden, they were simply off camera. So here's my challenge to you. Don't outsource your awareness. Learn the few indicators that move first, and you'll react faster than the crowd. If you want, I'll keep updating this as the Fed pick story develops and as the physical spread evolves. The next 90 days are the danger zone. Remember the date. May 15th is the scheduled end of the chair term. Markets can price the next era weeks or months early. Listen to language, not slogans. If the nominee talks about supporting growth more than protecting purchasing power, that's your clue. If you trade paper products, assume the rules can change mid-game. Use risk controls because leverage and surprise margin hikes don't mix. And this isn't personal financial advice. It's a map of the mechanics so you can make your own call with eyes open. And if you made it this far, type silver in the comments so I know you're locked in. Hit like, subscribe, and I'll see you in the next update.